The information provided in this video is for educational and entertainment purposes only and does not constitute professional financial, legal, or investment advice. Car loans, interest rates, and APR calculations involve complex financial variables that vary significantly based on individual credit profiles, geographical location, lender policies, and evolving market conditions. The figures and case studies mentioned are based on historical trends and potential outcomes, rather than guarantees of future performance. Viewers are strongly encouraged to conduct their own due diligence and consult with a certified financial advisor or a qualified professional before entering into any credit agreement or making a significant purchase. You are walking onto a car lot today and you think you have one. You spent 3 hours haggling over the sticker price of a $45,000 truck, eventually grinding the salesperson down to $42,000. You feel like a shark. You feel like you just saved $3,000 of your hard-earned money. But while you were focused on that $3,000 discount, the finance manager in the back office was quietly preparing a contract that would end up costing you an additional $9,000 over the next 6 years. They did not do this by changing the price of the truck. They did it by using a 3-letter acronym that most Americans misunderstand, ignore, or simply accept at face value: APR. Right now, millions of American drivers are trapped in what financial analysts call the monthly payment cycle. They are focused on whether they can afford $500 a month, completely oblivious to the fact that they are paying for that car twice over through interest. In this deep dive masterclass, we are breaking down the hidden architecture of American car loans. This is not a surface-level summary. We are going into the mechanics of how interest is calculated, why your APR is often higher than your interest rate, and how the difference of a single percentage point can determine whether you build equity in your vehicle or fall into a cycle of perpetual debt. By the end of this series, you will understand the math of the dealership better than the person selling you the car. To understand why this matters, we have to look at the current state of the American economy. Historical trends show that for nearly a decade, we lived in an era of cheap money. Interest rates were hovering near zero, and it was common to see advertisements for 0% financing. Those days are gone. We have shifted into a high-rate environment where the average interest rate for a new car has climbed significantly, often reaching between 7 and 10% for those with good credit, and skyrocketing to 20% or higher for subprime borrowers. When rates are this high, the interest is no longer a footnote in your contract. It is the main event. Let us start by defining our terms with clinical precision. Most people use interest rate and APR interchangeably. This is a fundamental mistake that costs consumers money every single day. The interest rate is the percentage of the principal loan amount that the lender charges you to borrow the money. If you borrow $30,000 at a 5% interest rate, that 5% is the cost of the capital itself. However, the APR, or annual percentage rate, is a much broader and more accurate measurement. The APR includes the interest rate plus any additional fees or costs associated with the loan. This includes loan processing fees, origination fees, and sometimes even documentation fees that the lender requires. Consider a case study involving 2 different loan offers for a $35,000 vehicle. Offer A has an interest rate of 6% with $2,000 in upfront loan fees rolled into the balance. Offer B has an interest rate of 6.5% but 0 fees. On the surface, Offer A looks better because the interest rate is lower. However, when you calculate the APR, Offer A might actually be more expensive because you are paying interest on the $2,000 of fees that were added to your principal. This is how dealerships and lenders can legally advertise a lower interest rate while still maximizing their potential outcomes at your expense. The math of a car loan is typically based on simple interest, but it is calculated daily. This means that every day you carry a balance, the lender calculates how much interest you owe based on that day's balance. This is why the timing of your payments and the structure of the loan term are so critical. In a typical 72-month loan, which has become the industry standard in the United States, your early payments are heavily weighted toward interest rather than principal. This is a process known as amortization. In the first year of your loan, a massive portion of your monthly payment is going directly into the lender's pocket, while the actual balance of your car loan barely moves. This leads us to the most dangerous trap in the American car market: the extended term loan. A decade ago, a 60-month loan was considered long. Today, 84-month and even 96-month loans are becoming common. Lenders offer these long terms to lower the monthly payment, making a luxury vehicle appear affordable to a middle-class budget. However, when you extend a loan to 84 months, you are not just paying more interest because of the time. You are often being charged a higher APR because the lender views a longer loan as a higher risk. Let us look at the data. On a $40,000 loan at an 8% APR, a 60-month term results in about $8,600 in total interest. If you stretch that same loan to 84 months to lower your payment, your total interest paid jumps to over $12,000. You are paying nearly $4,000 extra just for the privilege of a lower monthly payment. Furthermore, because cars are depreciating assets, an 84-month loan almost guarantees that you will be underwater or have negative equity for the majority of the loan's life. This means you owe more on the car than it is actually worth, a situation that can be catastrophic if the car is totaled in an accident or if you need to sell it unexpectedly. There is also the factor of the dealer markup. Most consumers do not realize that the interest rate they are quoted at a dealership is often not the lowest rate they qualify for. When a dealership sends your credit application to a bank, the bank might return a buy rate of, for example, 6%. This is the rate the bank is willing to accept. The dealership then adds 2 percentage points of markup and presents you with a contract at 8%. That 2% difference is pure profit for the dealership, often called reserve. In many cases, the dealership makes more money from the markup on your APR than they do from the actual sale of the vehicle. This is why understanding the mechanics of credit tiers is vital. In the United States, interest rates are tiered based on your FICO score. A person with a score of 780 might qualify for a 4% rate, while someone with a 620 score might be looking at 14%. On a standard car loan, that difference in credit score translates to tens of thousands of dollars over a lifetime of vehicle ownership. We are going to look at how these tiers are structured and how even a small 20-point bump in your credit score can change your financial trajectory. Throughout this masterclass, we are going to dissect the specific formulas used by lenders, the psychology of the finance and insurance office, and the step-by-step process of how to audit a loan contract before you sign it. We are moving beyond the simple question of can I afford this payment and toward the much more important question of what is the total cost of this capital. We are going to examine historical trends of car pricing versus wage growth to show why understanding APR is no longer optional for the American consumer, but a survival skill. By the time we finish this first deep dive, you will see the car buying process through a completely different lens. You will stop looking at the shiny paint and the leather seats and start looking at the amortization schedule. You will understand that the most expensive part of the car isn't the engine or the technology. It's the money you borrowed to buy it. We are going to peel back the curtain on the industry's most guarded secrets, from pre-computed interest traps to the reality of subprime lending, ensuring that the next time you step onto a lot, you are the most informed person in the room. This is about more than just a car. It is about protecting your financial future from the silent erosion of high-interest debt. To truly master the mechanics of your car loan, we must first dismantle the illusion of the advertised rate. Imagine if you are standing in a dealership in the spring of 2026. You see a banner promising a 5.9% interest rate. For most people, that number is the beginning and the end of their financial analysis. But for the savvy buyer, that number is merely a starting point. The real cost of your loan is the annual percentage rate, or APR, and the gap between that 5.9% and your actual APR is where the lenders hide their profit margins. The APR is a more comprehensive measure because it accounts for the time value of money and the immediate costs of securing the loan. When you sign a loan agreement, you are not just paying for the car, you are paying for the service of borrowing money. This service comes with a menu of fees. In 2026, we see historical trends where documentation fees, which used to be a standard $99, have ballooned in some states to over $600. Then there are origination fees, which the lender charges to process your application, and sometimes even credit report fees. If these fees are rolled into your loan balance, as they almost always are, you are now paying interest on the fees themselves. This is the first level of the APR trap. Let us look at a case study. Meet Alex. It is 2026, and Alex is purchasing a $40,000 electric crossover. Alex has been offered a 5.9% interest rate over 72 months. However, the dealership adds an $800 documentation fee, a $500 loan processing fee, and a $1,200 extended service contract into the financing. Instead of borrowing $40,000, Alex is now borrowing $42,500. Even though the interest rate remains at 5.9%, the APR climbs because the total cost of credit relative to the actual price of the car has increased. Over the life of the loan, Alex is not just paying interest on the $40,000 for the car. Alex is paying interest on that extra $2,500 of fees. This effectively raises the APR to a much higher level than the headline rate suggested. To understand why this happens, we have to look at the math of simple interest. Most American car loans utilize a simple interest formula, but it is applied on a daily basis. This is a critical distinction. In a daily simple interest loan, your interest is calculated by taking your current principal balance, multiplying it by your interest rate, and dividing that by 365 days. This means that every single day you carry a balance, a small amount of money is being added to what you owe. Imagine if you have a $30,000 balance at an 8% interest rate. Every single day, you are accruing approximately $6.58 in interest. If you make your payment on the first of the month, a specific portion goes to interest and the rest to principal. But if you are late by even 5 days, you have accrued an extra $32 in interest that must be paid off before a single penny touches your principal balance. This is how many Americans find themselves in a potential outcome where their balance barely drops despite making full payments every month. They are inadvertently allowing interest to eat their principal reduction by not understanding the daily nature of the calculation. This brings us to the concept of amortization. This is the process of spreading out a loan into a series of fixed payments. In the early stages of a car loan, the amortization schedule is heavily front-loaded with interest. This is because your balance is at its highest point. If you look at an amortization table for a $40,000 loan in 2026 at a 7% APR over 72 months, your first monthly payment might be $700. Of that $700, roughly $233 goes straight to interest. By the time you reach the final year of the loan, the interest portion of that same $700 payment might only be $20. The danger here is that most people trade in their cars every 3 to 4 years. If you take a 72-month loan and trade the car in at month 36, you have already paid the vast majority of the total interest the lender expected to earn, but you have only paid down a fraction of the actual car price. This is why so many consumers find themselves with negative equity, or being underwater. They owe more than the car is worth because the amortization schedule protected the lender's profit in the first half of the loan. Now, let us talk about the hierarchy of credit tiers in the current 2026 market. Your FICO score is the primary tool lenders use to determine your risk profile, and in a high-rate environment, the spread between tiers is massive. Lenders generally categorize borrowers into 5 main buckets: super prime, prime, non-prime, subprime, and deep subprime. Consider another case study comparing two neighbors, Sarah and Jordan, both buying the same $35,000 sedan. Sarah has a super prime score of 820. In 2026, she qualifies for a 4.5% APR. Her monthly payment over 60 months is $653, and she will pay a total of $4,180 in interest over the life of the loan. Jordan, however, has a subprime score of 590 due to some past medical bills and a high credit utilization ratio. Jordan is quoted an 18% APR for the same car. Jordan's monthly payment for the exact same vehicle is $889. Over the same 60 months, Jordan will pay over $18,000 in interest. The physical car is identical, the driving experience is the same, but because of the APR, Jordan is paying nearly $15,000 more than Sarah for the exact same asset. This is the reality of the American credit system. The cost of being in a lower credit tier is not just a slightly higher payment. It is the equivalent of buying a second, smaller car and giving it to the bank for free. In 2026, as vehicle prices remain high and wage growth struggles to keep pace, this disparity creates a massive wealth gap. But here is where the story gets even more complex. Even if Sarah and Jordan have the exact same credit score, they might not get the same APR. This is due to a mechanism known as the dealer reserve, or the interest rate markup. When a dealership runs your credit, they are acting as a middleman. They send your data to multiple lenders. If a lender comes back and says they will approve you at 6%, the dealership is not legally required to tell you that. They can present you with an offer for 8% and pocket the 2% difference as profit. This is a standard practice in the United States, and it is one of the primary ways dealerships make money in the modern era. Imagine if you were buying a house and your realtor could secretly add 2% to your mortgage rate and keep the cash. You would be outraged. Yet, in the car industry, this happens in thousands of transactions every single day. The salesperson might tell you they are doing you a favor by getting you approved, while the finance manager is actually padding the APR to hit their quarterly bonus targets. We are just beginning to scratch the surface of how these numbers are manipulated. To truly protect yourself, you need to know how to spot these markups before you ever step into the finance office. You need to understand how the length of the loan interacts with the total interest paid in a way that the monthly payment hides. And most importantly, you need to know the specific questions to ask that force the dealership to reveal the buy rate versus the contract rate. In the next part of this masterclass, we are going to dive into the psychology of the finance office. We will look at how they use the Foursquare method to distract you from the APR, and how they bundle products like gap insurance and VIN etching into your loan to further inflate that percentage. If you think the interest rate is just a number on a page, wait until you see how they use that number to control your entire financial life for the next 7 years. We are going to look at the specific 2026 tactics being used right now to keep you in a cycle of debt, and how you can break that cycle with a few simple calculations. The moment you step out of the bright, airy showroom and into the small windowless office of the finance and insurance manager, the entire game changes. In the industry, this room is often referred to as the box, and it is designed with a very specific psychological intent. By this point in the day, historical trends suggest you are likely exhausted. You have spent hours researching, test driving, and haggling over the price of the vehicle. Your mental defenses are down, and you are ready to be finished. This is exactly when the dealership introduces the most complex financial variables of the entire transaction. In 2026, while the technology on the manager's desk has become more advanced, the fundamental tactics used to manipulate your annual percentage rate remain remarkably consistent. To navigate this, you must understand the Foursquare method. Imagine a single sheet of paper divided into 4 quadrants: your trade-in value, the purchase price of the car, your down payment, and your monthly payment. The manager uses this sheet to perform a high-speed shell game. If you demand a higher value for your trade-in, they might give it to you, but they will simultaneously move that cost into the monthly payment quadrant by subtly increasing your APR or extending your loan term. Because most consumers only focus on one square at a time, usually the monthly payment, they fail to see how the total cost of the loan is being inflated in the other 3. Let us look at a case study involving a buyer named David in the year 2026. David is buying a $50,000 SUV. He has done his homework and negotiated the price down to $47,000. He feels confident. However, in the finance office, the manager presents a Foursquare worksheet. David insists he can only afford $750 a month. The manager looks concerned, taps a few keys, and says he can make $740 work. David is relieved, thinking he just saved another $10 a month. What David does not realize is that the manager achieved this by shifting the loan term from 60 months to 84 months and increasing the APR from 6% to 8%. Over the life of that loan, David's focus on that one square will result in him paying thousands of dollars more in interest than he would have at the original price he negotiated. This is the primary potential outcome when a buyer negotiates based on payment rather than the total cost of credit. This lead-in brings us to the most profitable part of the dealership's operation: back-end products. These are the additions like gap insurance, extended service contracts, tire and wheel protection, and VIN etching. In 2026, these products are often presented as essential protections for your high-tech vehicle. While some of these products can have value, the way they are financed is where the APR trap tightens. When you agree to a $3,000 extended warranty, the dealership does not just add $3,000 to your bill, they add it to your loan balance. This means you are paying your 8% or 10% APR on that warranty for the next 7 years. Consider the math for a buyer named Maria. Maria is offered a comprehensive protection package for $3,500. The manager tells her it only adds $45 to her monthly payment. To Maria, $45 sounds like the price of a couple of takeout meals. But if Maria has a 72-month loan at a 9% APR, that $3,500 package actually costs her over $4,500 by the time the loan is paid off. Furthermore, historical trends in the insurance industry show that Maria could likely purchase similar gap coverage through her primary auto insurer for a fraction of the cost, often as little as $5 or $10 a month, without ever paying interest on it. A particularly sophisticated tactic used in 2026 is known as payment packing. This occurs when the finance manager quotes you a monthly payment that is intentionally higher than what your credit score and the car's price actually justify. For example, if your legitimate payment should be $600, they might tell you it is $640. When you hesitate, they say they can throw in the oil change package and the interior protection for free if you agree to the $640 payment. In reality, you are paying for those products through the inflated APR or the hidden spread they built into the initial quote. This is why it is vital to ask for the buy rate, which is the actual interest rate the bank offered the dealership before the dealer added their markup. The dealership's goal in the box is to transform a simple commodity purchase into a complex financial instrument, where the APR is the primary lever for profit. They know that if they can increase your APR by just 1 point, they can generate hundreds or even thousands of dollars in reserve profit from the bank. In 2026, lenders often provide dealerships with a flat fee or a percentage of the total interest earned as an incentive to sign buyers at higher rates. This creates a direct conflict of interest between you and the person processing your paperwork. To illustrate the depth of this, imagine if you are financing $40,000 at an APR of 7% for 72 months. Your total interest paid is $9,064. If the dealer marks that rate up to 9%, your total interest jumps to $11,825. That 2% markup, which might seem negligible in a verbal conversation, costs you an additional $2,761. For the dealership, that is almost pure profit for a few minutes of data entry. We must also examine the specific 2026 trend of forced bundling. Some dealerships may attempt to tell you that you can only qualify for a certain low interest rate if you purchase a specific service contract or insurance product. This is a potential legal red flag in many jurisdictions and is often a violation of the lender's own policies. They are using the APR as a carrot to sell high-margin back-end products. Realize that your creditworthiness is determined by your financial history, not by your willingness to buy a paint protection plan. Step by step, the process of defending yourself in the finance office begins with a transition from emotional buyer to clinical auditor. You must deconstruct every line item. If a fee is being charged, you must ask what it covers and if it is negotiable. In many states, documentation fees are capped by law, but other fees like delivery and handling or electronic filing fees are often used as placeholders to increase the amount financed, which in turn increases the total interest you will pay over the life of the loan. The most effective way to see through the fog of the finance office is to bring your own financing to the table. By obtaining a pre-approval from a credit union or an online lender before you ever visit the dealership, you set a ceiling on the APR. If the dealership cannot beat your 4% or 5% rate, you simply use your own check. This forces the finance manager to compete with the market, rather than exploiting your lack of information. As we continue this masterclass, we are going to look at the actual spreadsheets used by these managers. We will break down the exact formulas for daily interest accrual so you can see why your balance stays so high for the first 3 years of your loan. But before we get to the math, we have to address the biggest hidden danger of all: the transition from a standard loan to a lease-like structure that many dealers are pushing in 2026. They are finding new ways to hide interest in balloon payments and residual values that make the APR look lower than it truly is. In the next section, we are going to expose the math behind the balloon loan and why it might be the most expensive way to drive a car in the current economy. A balloon loan is essentially a financial mirage designed to make a luxury lifestyle appear accessible on a modest budget. In the automotive market of 2026, where the average price of a new electric truck has surpassed $80,000, dealerships are increasingly turning to these complex structures to close deals that would otherwise be impossible. To the untrained eye, a balloon loan looks like a hybrid between a lease and a traditional purchase. You make relatively small monthly payments for a set period, typically 3 to 5 years, but at the very end of that term, you are hit with one final massive payment, the balloon. While the salesperson will frame this as giving you the flexibility of a lease with the benefits of ownership, the mathematical reality often leads to a potential outcome of significant financial strain. Imagine a buyer named Liam in 2026. Liam has his heart set on a top-tier heavy-duty pickup truck with a sticker price of $90,000. Even with a decent down payment of $10,000, a standard 60-month loan at an 8% APR would result in a monthly payment of roughly $1,600. This is far beyond Liam's budget. The finance manager then introduces the balloon option. They offer Liam a 60-month term where his monthly payments are slashed to just $900. The catch is a final balloon payment of $45,000 due at the end of month 60. Liam sees the $900 figure and feels a sense of relief, thinking he has found a way to drive his dream truck without the nightmare payment. However, we must look at the hidden cost of the interest on that $45,000. In a traditional loan, your principal balance decreases with every single payment you make. As the principal drops, the amount of interest you owe each month also drops. In Liam's balloon loan, that $45,000 residual amount never decreases during those 60 months. Liam is paying 8% interest on that entire $45,000 every single day for 5 years. That is $3,600 in interest every year just on the balloon portion alone, totaling $18,000 in interest before he even begins to touch the principal of that final payment. When you add the interest on the other $45,000 he is actually paying down, the total cost of credit becomes staggering compared to a traditional loan. This structure creates a high-stakes scenario at the end of the term. Historical trends in the 2026 automotive market show that vehicle depreciation is becoming more volatile, especially as battery technology in EVs advances rapidly. Let us look at the potential outcome for Liam when month 60 arrives. He owes $45,000 in a lump sum. He has 3 choices: pay the $45,000 in cash, refinance the $45,000 into a new loan, or trade the truck in. If Liam does not have $45,000 sitting in a high-yield savings account, he is forced to refinance. But now, he is refinancing a 5-year-old truck. Historical trends indicate that used car interest rates are significantly higher than new car rates. Liam might find himself moving from an 8% APR to a 12% APR on a vehicle that is already out of warranty and beginning to require expensive maintenance. The trade-in option is where the trap often snaps shut. If the market for heavy-duty trucks has dipped or if Liam's truck has higher than average mileage, it might only be worth $38,000 by 2026 standards. Because his balloon payment is $45,000, Liam is $7,000 underwater. To get into a new vehicle, he has to roll that $7,000 of negative equity into his next loan. This is how the cycle of perpetual debt begins. He is now paying interest on the $7,000 he still owes for a truck he no longer owns, all while starting a new balloon loan on a new vehicle. Lenders love these products because they effectively guarantee a returning customer who is increasingly dependent on the lender's willingness to roll over debt. To understand the depth of this, we need to examine the step-by-step math of how the APR is applied to a balloon balance. In a daily simple interest environment, the lender takes the annual rate, divides it by 365, and applies it to the current balance. On Liam's $45,000 balloon, the daily interest charge is roughly $9.86. Every month, about $300 of Liam's $900 payment is going exclusively toward the interest on the money he isn't even paying back yet. Only $600 is left to cover the interest on the other half of the loan and a tiny bit of the principal. This slow-motion amortization means Liam is building almost zero equity in the truck during the first 3 years of the loan. Furthermore, dealerships in 2026 often use the balloon payment to hide the true impact of a high APR. Because the monthly payment is artificially suppressed by the large residual, a buyer might not notice the difference between a 6% APR and a 10% APR as easily as they would on a standard loan. On a $90,000 truck, that 4-point difference in APR over 5 years represents nearly $20,000 in additional interest. In the finance office, this is often obscured by focusing the conversation on the monthly payment and the buyback guarantee. They might tell Liam that the dealership will guarantee to buy the truck back for the balloon amount at the end of the term. But these guarantees are often riddled with fine print conditions regarding vehicle condition, tire wear, and strict mileage limits. If Liam drives 20,000 miles a year instead of the allotted 12,000, that guarantee is voided, leaving him fully responsible for the negative equity. Case studies from previous high-interest cycles show that balloon loans surge in popularity right before market corrections. When car prices are at an all-time high, the only way to keep the monthly payment within the reach of the average American worker is to push the debt further into the future. It is a form of financial procrastination. In 2026, we are seeing this play out with high-end electric vehicles. As new solid-state batteries are teased for the 2027 and 2028 model years, current lithium-ion models are expected to see a sharp drop in resale value. A buyer taking a balloon loan on a 2026 Electron Volt is essentially gambling that the residual value of the car will be higher than the balloon payment in 5 years. A gamble that historical trends in technology sectors suggest is rarely a winning one. There is also the psychological factor. Liam feels like a truck owner, but for the first 60 months, he is effectively just a long-term renter with a massive liability looming at the end. The sense of ownership is an illusion maintained by the structure of the contract. If he wants to sell the truck in year 3, He has to find a way to cover the massive gap between the truck's market value and the high principal balance that has barely moved. This lack of liquidity can be devastating if Liam faces an unexpected life event, such as a job loss or a medical emergency, where he needs to lower his monthly expenses quickly. He cannot simply sell the truck and walk away. He would need to bring a check for thousands of dollars to the closing table just to get out of the debt. We have to look at how these balloon loans are marketed as flexibility. The pitch is always about having options. They will say you can keep it, sell it, or trade it. But in reality, the high APR and the slow amortization often take those options away. When the math is laid out clinical and cold, the balloon loan is revealed as a method to maximize the interest collected by the lender, while minimizing the equity built by the borrower. It is the ultimate tool for the dealership to sell a car that the customer cannot truly afford. As we move forward in this deep dive, we are going to look at how the daily interest calculation can be used in your favor. If you are already in a car loan, there are specific mathematically proven ways to disrupt the amortization schedule and save thousands in interest without refinancing. We are going to look at the power of the principal-only payment and why the timing of your payment matters just as much as the amount. But before we get to the solutions, we have to look at the darkest corner of the American car market, the subprime APR. In the next part, we are going to look at how lenders structure loans for those with lower credit scores and why the math for a 15% APR makes it almost impossible to ever own the car outright. We are going to break down the specific 2026 subprime tactics and how the buy here, pay here model is a trap designed for total financial capture. To understand the true gravity of the American car loan crisis, we have to descend into the world of subprime lending, a sector that in 2026 has become a multi-billion-dollar engine of financial capture. When your credit score falls below 600, you enter a parallel financial universe where the rules of prime lending no longer apply. In this space, the annual percentage rate is not just a fee for borrowing money. It is a weight that often ensures the borrower never actually gains ownership of the asset. We are talking about APRs that range from 18% to as high as 36%, which is the legal limit in many states. This is where the math becomes predatory, and the potential outcomes for the average worker become increasingly bleak. Imagine a character named Marcus living in a suburb of Atlanta in 2026. Marcus is a delivery driver who needs a reliable vehicle to maintain his income. Due to some past credit challenges during the economic shifts of the early 2020s, his FICO score sits at 580. He walks into a buy here, pay here dealership, a specific type of establishment where the dealer acts as both the salesperson and the bank. Marcus finds a 2020 Honda Accord with 90,000 miles on the odometer. The sticker price is $22,000, which is already significantly above its Blue Book value. The dealer tells Marcus that because of his credit, he is a high-risk borrower. They offer him a 72-month loan at a 25% APR. To Marcus, the only number that matters is the monthly payment. The dealer structures the loan so that Marcus pays $640 a month. Marcus calculates that he can make this work if he picks up extra shifts. What Marcus does not see is the mathematical prison being constructed around him. At a 25% APR, the interest on $22,000 is not a secondary cost. It is almost the price of a second car. Over the 72-month term, Marcus will pay $24,080 in interest alone. By the time the loan is finished, Marcus will have paid over $46,000 for a $22,000 used car that will likely be worth less than $5,000 by the year 2032. Let us look at the step-by-step math of Marcus's first month to see why he will likely never build equity. In a daily simple interest environment, the lender calculates interest by multiplying the balance by the daily rate. Marcus's daily rate is 0.068%. On his first day of ownership, with a $22,000 balance, he is charged $15.06 in interest. Over a 30-day month, he accrues $451.80 in interest. When Marcus makes his hard-earned payment of $640, only $188.20 actually goes toward reducing the balance of the car. The following month, his balance is $21,811. The daily interest barely budges. Historical trends in subprime lending show that borrowers in Marcus's position often face a maintenance crisis before they reach month 30 of the loan. Because the car has high mileage, it might need a $3,000 transmission repair. Because Marcus is spending nearly $700 a month on the loan and insurance, he has no emergency savings. He cannot afford the repair, but he cannot work without the car. If he misses a payment to fix the car, The lender in 2026 has a technological advantage that did not exist in previous decades. This is the era of the starter interrupt device and the GPS kill switch. In many subprime contracts today, the car is fitted with a small electronic module. If Marcus is more than 48 hours late on his payment, the lender can remotely disable the ignition system. Marcus walks out to his car at 5 in the morning to start his shift, and the engine refuses to turn over. A notification pops up on his smartphone from the lender's app, informing him that his vehicle has been deactivated and will remain so until the balance and a late fee are paid in full. This is not a hypothetical scenario. It is a standard business practice for hundreds of lenders across the United States. Furthermore, the buy here, pay here model is often predicated on the churn. Lenders in this space often anticipate that a subprime borrower will default. Historical trends show that some vehicles are repossessed and resold 4 or 5 times in a single year. The dealer takes a $2,000 down payment from Marcus, collects 6 months of payments, then repossesses the car when he hits a financial hurdle. They then clean the car, put it back on the lot, and sell it to the next person at the same 25% APR. This cycle of repossession and resale is far more profitable than a completed 60-month loan. It is a system designed for total financial capture, where the borrower provides a steady stream of cash flow, but never achieves the terminal point of the contract. In 2026, we also see the rise of what is called yo-yo financing or spot delivery. This is a tactic where a dealership tells a borrower like Marcus that his financing is approved and lets him drive the car off the lot today. A week later, the dealer calls and claims that the financing fell through, or that the bank required a higher interest rate or a larger down payment. They use the threat of a stolen vehicle report to force the borrower back to the dealership to sign a new contract with an even higher APR. Because the borrower has already shown the car to their family and integrated it into their life, they are psychologically vulnerable and often sign the more expensive contract just to end the stress. We must also analyze the impact of the payment frequency trap. Many subprime lenders shift from monthly payments to weekly or bi-weekly payments. They might tell Marcus he only needs to pay $160 a week. To a person living paycheck to paycheck, $160 sounds much more manageable than $640. However, there are 52 weeks in a year. Paying weekly means you are making the equivalent of 13 monthly payments per year instead of 12. While this theoretically helps pay the loan down faster, the lenders often pair this with a higher APR and fees that negate any benefit to the borrower. The data regarding subprime delinquency in 2026 suggests that the average subprime car loan is now more likely to end in repossession than in a successful payoff. For those who do manage to finish the loan, the total cost of ownership is so high that it prevents them from moving into a higher credit tier or saving for a home. The APR has effectively acted as a ceiling on their economic mobility, but even for those with good credit, there are invisible forces at work that can turn a prime loan into a financial burden. Most people believe that once they sign the contract, the math is set in stone. They don't realize that they have the power to disrupt the lender's math and take back control of the amortization schedule. There are specific, legal, and highly effective ways to slash the total interest you pay, even if you are already 3 years into a loan. In the next part of this deep dive, we are going to move from the dangers of the loan to the solutions. We are going to look at the power of principal-only payments and the specific math of how an extra $50 a month can save you thousands in interest and shave a year off your loan term. We will break down why you should never just send extra money without a specific instruction to the lender, and how the 2026 banking apps are making it harder for you to pay off your principal early. You are about to learn how to play the lender's game better than they do. To understand how to disrupt the bank's profit model, we have to look at the user interface of your lending app. In 2026, major auto lenders have moved toward highly streamlined, mobile-first payment systems. On the surface, these apps are designed for convenience. They offer one-click payments, biometric logins, and easy-to-read progress bars. However, beneath that polished design lies a series of dark patterns intended to keep you on the original amortization schedule. When you click the pay button, the app typically defaults to a standard payment. If you attempt to send an extra $50 or $100, the system will often present you with a confusing choice. Do you want to apply this to your next payment or apply it to your principal? Historical trends show that a significant majority of consumers mistakenly choose the apply to next payment option. To the bank, this is a massive win. When you apply extra money to the next payment, you are simply prepaying your future obligation. You are giving the bank an interest-free loan of your own money. Your principal balance remains exactly where the bank calculated it would be. and interest continues to accrue on that higher balance every single day. The potential outcome of this mistake is that you lose the compounding benefit of early principal reduction. To the bank, you have not shortened the loan. You have just moved your due date. To play the game correctly, you must ensure that every single extra dollar is coded as a principal-only payment. This is the only way to break the mechanical logic of the amortization table. Let us look at a case study involving a character named Chloe. It is the summer of 2026, and Chloe has just purchased a high-efficiency hybrid crossover for $42,000. Because rates have remained stubbornly high, she was forced to take a 9% APR over an 84-month term. Her monthly payment is $675. If Chloe follows the standard schedule, she will pay over $14,700 in interest by the time 2033 rolls around. Chloe decides to execute a surgical strike against her loan balance. She adjusts her budget to find an extra $100 per month. However, she does not just send $775 through the standard portal. She logs into her lender's 2026 web dashboard, navigates past the bright Pay Now buttons, and finds the manual payment section. She selects principal only and enters the $100. Here is the step-by-step math of what happens to Chloe's loan. On a $42,000 balance at 9%, her daily interest charge is approximately $10.35. In the first month, $315 of her $675 payment is swallowed by interest. Only $360 goes to the car. But when she adds that extra $100 directly to the principal, she has effectively doubled her progress for that month. By reducing the principal balance faster than the bank's algorithm expected, the daily interest charge for the following month is calculated on a smaller number. The potential outcome for Chloe is staggering. By consistently adding that $100 to the principal every month, she doesn't just save a few $100s. She slashes her total interest paid from $14,700 down to approximately $10,400. She saves $4,300 in cold, hard cash that would have otherwise gone to the lender's shareholders. More importantly, she shaves 17 months off the life of the loan. Instead of being in debt for 7 years, she owns the car in less than 6. This is how you use the bank's own simple interest math against them. However, in 2026, lenders have introduced friction points to prevent this. Some lenders require you to mail a physical check to a separate address for principal-only payments. Others hide the principal-only toggle deep within the settings menu of their app. If your lender does not provide a clear digital path for principal-only payments, the clinical solution is to call the customer service line. You must be precise with your language. You say, "I am making an additional payment of X dollars today, and I am formally instructing you to apply the entirety of this amount to the principal balance only. Do not move my next due date forward." You must then verify this on your next statement. Look for the line item labeled Principal Reduction. If you see your next payment due date has moved from July to August, the lender has ignored your instruction and categorized it as a prepayment. You must call back and demand a payment correction. Historical trends in the industry suggest that lenders rely on the fact that 95% of people will never check their statements with this level of scrutiny. Another high-impact tactic to consider is the bi-weekly payment strategy. Most people are paid every 2 weeks, but their car loan is due once a month. If you split your monthly payment in half and pay it every 2 weeks, you will end up making 26 half payments in a year. This is the equivalent of 13 full monthly payments instead of 12. This extra payment happens almost invisibly because it aligns with your paychecks. Let us revisit Chloe's scenario. If she switches to bi-weekly payments of $337.50, she is effectively making an extra $675 payment every year. When combined with the daily interest calculation, this 13th payment has a massive impact. Because she is paying every 14 days instead of every 30, the amount of interest that has a chance to accrue between payments is smaller. More of her money hits the principal sooner. This is the beauty of the simple interest model when you understand it. The faster you get the money to the lender, the less they can charge you for the time you held it. We also need to discuss the timing of these payments. Because interest is calculated daily, the earlier in the month you pay, the less interest you accrue. If your payment is due on the 15th but you pay on the 1st, you have saved 14 days of interest on that portion of the principal. While the savings on a single month might only be a few dollars over an 84-month loan, this behavior can result in hundreds of dollars in savings. It is a game of inches, but in the 2026 economy, those inches determine whether you are building wealth or just servicing debt. You must also be wary of the 2026 trend of the interest-only deferral offer. During the holidays or summer months, many lenders will send an email or a push notification saying, "Skip your next payment for a small fee." They frame it as a gift of flexibility. In reality, it is an interest trap. When you skip a payment, the principal does not move, but the daily interest continues to pile up. That unpaid interest is often added to your principal balance, a process called capitalization. You end up paying interest on the interest you skipped. It is a potential outcome that can undo a whole year of diligent principal-only payments in a single month. The core lesson of this deep dive into payment mechanics is that the loan contract is not a passive document. It is a live mathematical battle. Every time you interact with your lender, you are either surrendering to their amortization schedule or you are taking a piece of your equity back. By mastering the principal-only payment, the biweekly schedule, and the timing of your transfers, you transform from a borrower into an auditor. But even with the best payment strategy, there is a limit to what you can achieve if your starting APR is too high. Sometimes the only way to truly win is to exit the contract entirely. This leads us to the most powerful tool in the consumer's arsenal, but also the most misunderstood: refinancing. In the next part of this masterclass, we are going to look at the 2026 landscape of the car loan refinance. We will break down the magic window, the specific point in your loan life where you have the most leverage to drop your rate. We will look at how to use credit unions to decapitate a dealership's marked up APR, and the one math mistake people make when refinancing that actually ends up costing them more in the long run. Refinancing a car loan in 2026 is often described as the financial escape hatch, but most people treat it like a simple coupon when it is actually a complex surgical procedure on your debt. When we talk about decapitating the dealership's marked up APR, we are referring to the removal of the middleman. By the time you reach the 6-month mark of your loan, you have likely established a record of on-time payments, and the initial hard inquiry that dinged your credit score when you bought the car has begun to fade. This opens what financial analysts call the magic window. In the current 2026 economy, where market rates are volatile, this window is your primary opportunity to correct a bad deal made in a moment of weakness or exhaustion at the dealership. Imagine a character named Sophia. In early 2026, Sophia purchased a $45,000 crossover. Because she was in a rush and her credit was hovering around 680, the dealer placed her in a 72-month loan at an 11% APR. Sophia's monthly payment is $854. If she stays on this path, she will pay over $16,000 in interest. The dealer's buy rate from the bank was actually 8.5%, but they added a 2.5% markup, essentially pocketing thousands of dollars of Sophia's future earnings as a commission. 8 months later, Sophia's credit score has climbed to 720. She enters the magic window. She decides to bypass the dealership and the major national banks entirely, going straight to a local credit union. In 2026, credit unions remain the most potent weapon against high car loan APRs because they are member-owned and do not have the same profit-maximizing pressures as commercial lenders. The credit union offers Sophia a 6.5% APR to refinance her remaining balance, which is now approximately $41,000. This is where Sophia must avoid the fatal math mistake that traps millions of Americans. When the credit union representative asks her what monthly payment she wants, the temptation is to say, "Make it as low as possible." If Sophia takes that $41,000 balance and refinances it into a brand new 72-month loan to drop her payment, she is committing a slow-motion financial suicide. Even with a lower interest rate, by extending the total time she is in debt from the original 6 years to nearly 7.5 years, she might end up paying more total interest than she would have with the original high-rate loan. Historical trends show that lenders love it when you focus only on the monthly savings. If Sophia's new payment drops to $690, she feels like she has won, but the math shows a different potential outcome. By resetting the clock, she is paying interest for an additional 18 months. To truly win, Sophia must refinance the remaining $41,000 for the remaining time she had left on her original loan, 64 months. By keeping the term the same but dropping the APR by 4.5%, she ensures that every dollar saved goes directly into her pocket, rather than being redistributed over a longer period. Let us look at the clinical breakdown of the savings. At 6.5% over 64 months, Sophia's payment drops to $760. She is saving $94 every single month. Over the remaining life of the loan, that is over $6,000 in savings. This is the power of the magic window. However, in 2026, there is a new hurdle Sophia must clear: the loan-to-value or LTV ratio. As the 2026 car market faces rapid shifts in technology, specifically with electric vehicle depreciation, many cars are losing value faster than their owners can pay down the principal. If Sophia's crossover is now only worth $38,000, but her loan balance is $41,000, she has an LTV of 108%. Many credit unions will not refinance a loan if the LTV exceeds 100%, or they will charge a significantly higher APR to compensate for the risk. This is why the timing of the refinance is so critical. If you wait until you are deep in negative equity, the escape hatch is welded shut. You are trapped in that high-interest contract until you can pay down the difference in cash. To execute a successful refinance in 2026, you must conduct a step-by-step audit of the new contract versus the old one. First, you check for prepayment penalties in your original loan. While these are rare in standard prime auto loans, they are still prevalent in subprime and some secondary market contracts. If your current lender charges a $500 fee to close the loan early, you have to factor that into your break-even analysis. Second, you must look at the fees associated with the new loan. In 2026, some lenders have introduced application fees or title transfer fees that can range from $100 to $300. If you are only dropping your APR by 0.5%, these fees might mean it takes you 2 years of payments just to break even on the cost of the refinance. A case study of a $30,000 loan shows that dropping your rate from 8% to 7.5% only saves you about $7 a month. If the fees to refinance are $300, you are essentially paying for 42 months of savings upfront. That is not a refinance, that is a lateral move. Third, you must consider the simple interest daily accrual during the transition. When you refinance, the new lender pays off the old lender. There is often a gap of several days where interest is accruing on both ends, or where your final payoff amount from the old lender is slightly higher than your current balance due to per diem interest. You must ensure the new loan covers the total payoff, not just the balance shown on your last statement. In 2026, we are also seeing a rise in digital-only refinancing platforms that use AI to give you an instant APR quote. While these are convenient, you must be wary of the hidden costs. These platforms often act as brokers, and they might add a small percentage to the lender's rate as their fee. This is just a digital version of the dealer markup. The most clinical and effective potential outcome is found by going directly to the source, the credit union's own website or office. Beyond the math, refinancing is a psychological reset. It is the moment you stop being a victim of the dealership's high-pressure environment and start being the manager of your own capital. But there is a danger that even a perfect refinance cannot solve. In 2026, the American road is a high-risk environment, and if your car is totaled or stolen, the interaction between your insurance company, your lender, and your APR can create a financial black hole. Many people think that because they have a low interest rate, they are safe. They don't realize that the way the bank calculates your payoff in a total loss scenario can leave you with thousands of dollars in debt and no car to show for it. We are going to look at the specific 2026 data on insurance payouts versus loan balances and how the APR you negotiated affects your vulnerability in an accident. In the next part, we are going to dive into the world of gap insurance, total loss claims, and the secret lien holder clauses that give banks the right to take your insurance check before you ever see a dime. This is the part of the car loan that nobody talks about until it is too late, and it is the single biggest threat to your equity in 2026. When your insurance company declares your vehicle a total loss, they are not looking at what you owe the bank. They are looking at what the market says the car is worth at that exact second. In the 2026 automotive landscape, this creates a massive financial chasm known as the equity gap. To understand this, you have to understand the legal relationship between you, your car, and your lender. When you sign a car loan, you do not technically own the car in the eyes of the law. You are the registered owner, but the bank is the lien holder. The bank holds a security interest in the vehicle. This means that in the event of a total loss, whether from a high-speed collision on a rain-slicked highway or a sudden flood in a suburban driveway, the insurance payout does not go to your bank account. It goes directly to the lender to satisfy the debt. Imagine a character named Ethan. In early 2026, Ethan purchased a brand new electric performance sedan for $65,000. Because he wanted to keep his cash for other expenses, he put $0 down and financed the entire amount, including taxes and fees, totaling $70,000. His APR, reflecting the higher rates of the 2026 market, was 9.5% for a 72-month term. 6 months into the loan, Ethan is involved in a multi-car pileup. He is fine, but the car's sophisticated sensor array and carbon fiber frame make it too expensive to repair. The insurance company totals it. This is the moment Ethan experiences the clinical reality of actual cash value, or ACV. Historical trends show that a new car loses approximately 20% of its value the moment it is driven off the lot. By month 6, Ethan's $65,000 sedan is worth $52,000 in the eyes of the insurance adjuster. However, because Ethan had a high APR of 9.5%, his principal balance has barely moved. Most of his first 6 payments went toward interest. His loan balance still sits at $68,500. The insurance company sends a check for $52,000 to the bank. Ethan is now left with no car and a $16,500 bill for an asset that no longer exists. This is the potential outcome for anyone who ignores the relationship between depreciation and APR. The reason your APR dictates the size of this financial wound is rooted in the amortization schedule we discussed earlier. In a high-interest environment, the lender takes their profit first. If Ethan had a 3% APR, more of his monthly payment would have gone toward the principal, narrowing that $16,000 gap. But at 9.5%, the bank is capturing so much interest in the first year that the borrower's debt remains artificially high while the car's value is in freefall. In 2026, where vehicle technology advances every 6 months, depreciation is more aggressive than ever. If you are financing a high-tech vehicle at a high APR with low equity, you are essentially driving a financial time bomb. This leads us to the critical yet often misunderstood product known as gap insurance, or guaranteed asset protection. The name is slightly misleading because in the world of finance, nothing is guaranteed, but gap is designed to cover the difference between the ACV payout and the remaining loan balance. In 2026, gap is no longer a luxury. It is a necessity for anyone financing more than 80% of a vehicle's value. However, how you acquire this protection is where the math of the APR can once again work against you. Let us look at a case study involving a buyer named Mia. When Mia bought her SUV in 2026, the finance manager offered her gap insurance for a one-time fee of $900. Mia agreed, and the manager rolled that $900 into her 72-month loan at an 8% APR. Mia thinks she paid $900 for protection. In reality, because that fee is being financed over 6 years, she will pay over $300 in interest on the insurance itself. By the time the loan is paid off, Mia's $900 protection policy has cost her $1,200. A more clinical approach and a historical trend among savvy buyers is to check with your primary auto insurance provider first. In 2026, many major insurers offer a version of gap or total loss replacement for as little as $5 to $10 per month. If Mia had added this to her regular insurance policy, she would only pay for it as long as she needed it, likely for the first 3 years of the loan until her principal balance dropped below the car's value. By the time she reached equity in year 4, she could cancel the coverage. By financing it at the dealership, she is locked into paying for that protection for the full 72 months, even when the car is worth more than the loan and the protection is technically useless. Furthermore, we must examine the loss payable clause in your loan contract. This is the fine print that gives the bank the right to dictate how insurance proceeds are handled. In 2026, some lenders have introduced clauses that allow them to keep the insurance money to pay down the loan even if the car is reparable, if they deem the damage significant enough to threaten their security interest. This means you could be left with a car that needs $20,000 in repairs and a bank that has seized the $20,000 insurance check to lower your balance, leaving you with a broken car and no way to fix it. This is why reading the security agreement is as important as looking at the APR. Step by step, if you find yourself in a total loss situation in 2026, your first move is not to accept the insurance company's first offer. The ACV is a negotiation. You must provide a case study of similar vehicles in your immediate geographical area. Use local listings from 2026 to show that a replacement for your specific trim and mileage costs more than the adjuster is offering. Every $1,000 you add to the ACV payout is $1,000 less you have to pay the bank out of your own pocket. We also need to address the 2026 reality of the diminishing return on high-tech repairs. In previous decades, a fender bender was a minor inconvenience. Today, a single sensor in a bumper can cost $3,000 to calibrate. This high cost of repair means insurance companies are totaling cars much faster than they used to. A car that is perfectly drivable, but has a compromised sensor suite might be declared a total loss. If you are in a high APR loan, this means a minor accident could trigger a major financial crisis. The interplay between your APR, your insurance policy, and your vehicle's depreciation is the three-legged stool of automotive finance. If any leg is weak, the whole structure collapses during an accident. Most people focus so much on getting the car that they forget to plan for the day the car goes away. In the current economy, the gap between debt and value is the widest it has been in decades. If you are not calculating your potential exposure to a total loss every 6 months, you are not managing your loan. You are just hoping for the best. As we move toward the conclusion of this masterclass, we are going to look at the long-term consequences of these high-interest structures. We have talked about the purchase, the payments, the refinance, and the accidents. Now we have to talk about the aftermath. What happens to your credit, your future borrowing power, and your net worth when you finally exit one of these loans, or worse, when the loan exits you through repossession. We are going to break down the 2026 credit reporting algorithms and how a single car loan can dictate your ability to buy a home 5 years from now. We are going to look at the math of the default and the secret world of deficiency judgments, where a bank can sue you for the remaining balance even after they have taken the car back. This is the final frontier of the car loan deep dive, and it is the most important part for your long-term financial survival. The moment the tow truck pulls out of your driveway with your vehicle at 3 o'clock in the morning, most people assume the nightmare has reached its conclusion. They believe that by surrendering the asset, they have effectively traded the car for the debt. In the clinical reality of the 2026 American financial system, this is a dangerous misconception. Repossession is not the end of your relationship with the lender. It is often the catalyst for a second, more aggressive phase of debt collection that can haunt your financial profile for the next decade. To understand the long-term consequences of a high APR loan gone wrong, we must look at the mechanics of the default and the legal aftermath that follows the loss of the vehicle. Imagine a character named Daniel in the year 2026. Daniel is a mid-level manager in the logistics industry living in a suburb of Columbus, Ohio. 2 years ago, Daniel purchased a $60,000 heavy-duty truck. Because his credit score was in the low 600s at the time, he accepted a 72-month loan at an 18% APR. For 24 months, Daniel diligently made his $1,300 monthly payments. However, due to a shift in the global supply chain in early 2026, Daniel's company downsized, and he found himself unemployed. After missing 3 consecutive payments, the lender exercised their right to repossess the vehicle. This is where the math of the high APR loan becomes devastating. At an 18% interest rate, a massive portion of Daniel's $31,000 in total payments over the last 2 years went toward interest rather than principal. When the truck was repossessed, Daniel still owed $48,000 on the loan. In 2026, the lender does not take that truck and sell it for the retail price you see on a dealership lot. They take it to a wholesale auction. Historical trends show that vehicles sold at these auctions typically fetch only 60 to 70% of their fair market value, because they are bought by other dealers who need to leave room for their own profit margins. At the auction, Daniel's truck, which might be worth $45,000 on the open market, sells for $32,000. The lender then subtracts the costs of the repossession itself. In 2026, these costs are meticulously itemized. The $500 towing fee, the $30 per day storage fee, the costs of cleaning the vehicle, and the auction house commission. After these fees are subtracted, only $30,000 is applied to Daniel's $48,000 balance. Daniel is left with a deficiency balance of $18,000. Even though he no longer has the truck, he is legally obligated to pay the bank $18,000 plus the continued interest on that remaining balance. This is known as a deficiency judgment. In many states across the U.S. in 2026, a lender can take this deficiency judgment to court to seek a garnishment of your future wages or a levy on your bank account. This means that even when Daniel finds a new job, a portion of his paycheck could be legally diverted to pay for a truck he lost years ago. This is the potential outcome of the high APR trap that many borrowers fail to consider when they sign the initial contract. They focus on the risk of losing the car, but they ignore the risk of keeping the debt. Furthermore, we must analyze the impact on Daniel's credit report through the lens of 2026 credit scoring models. Most consumers are familiar with the standard FICO score, but by 2026, lenders have shifted heavily toward FICO 10T and VantageScore 4.0, which utilize trended data. Unlike older models that only look at a snapshot of your current debt, trended data looks at your financial behavior over a 24-month rolling window. It tracks whether you are paying down your balances or just making minimum payments. When Daniel's loan moved into delinquency and eventually repossession, it did not just drop his score by a set number of points. The trended data model flagged a high-risk trajectory months before the actual default. In the 2026 credit landscape, a repossession stays on your report for 7 years, but its impact is felt most acutely in the first 24 months. For Daniel, this means that for the next several years, his ability to secure any form of credit, whether for a modest apartment lease, a credit card, or a future car loan, will be severely compromised. Lenders who do see his report will view him as a maximum risk borrower, potentially leading to even higher APR offers in the future, creating a self-perpetuating cycle of high-interest debt. There is also the often misunderstood concept of the charge-off. Many people see the word charged off on their credit report and assume the debt has been forgiven or canceled. Clinically, a charge-off is merely an accounting term used by the bank. It means the bank has moved the debt from their active assets to their bad debt category for tax purposes. It does not mean you no longer owe the money. In 2026, banks frequently sell these charged-off accounts to third-party debt buyers for pennies on the dollar. These debt buyers are often far more aggressive than the original bank, using automated legal filing systems to flood local courts with lawsuits to collect on those deficiency balances. This ripple effect extends into other areas of Daniel's life that seem unrelated to car finance. In 2026, insurance companies use credit-based insurance scores to determine your premiums for homeowners and auto insurance. Historical trends indicate that a person with a repossession on their record may pay 50 to 100% more for basic insurance coverage than someone with a clean credit history. Furthermore, many employers in the financial, government, and technology sectors conduct credit checks as part of their background screening. A repossession and an outstanding deficiency judgment can be viewed as a sign of financial instability, potentially costing Daniel job opportunities in his field. Step by step, the destruction of Daniel's net worth is a masterclass in how interest functions as a double-edged sword. When you are saving, interest builds your wealth. When you are borrowing at high APRs, interest serves as a mechanism to transfer your future earnings to the lender's balance sheet. By the time Daniel is 50 years old, the $18,000 deficiency he owed in 2026, if left unpaid or settled poorly, could have grown through legal fees and statutory interest into a much larger burden, or at the very least, cost him tens of thousands in lost investment opportunities. We must also look at the psychological toll of this financial capture. In 2026, the constant connectivity of our digital lives means that debt collectors can reach you through social media, encrypted messaging apps, and automated voice systems. The stress of an unresolved car loan default can lead to a state of financial paralysis, where the borrower stops engaging with the banking system altogether, moving into a cash-only existence that further limits their economic mobility. But even in this bleak landscape, there are specific legal protections and mathematical strategies that can be used to mitigate the damage. You must know how to audit the lender's sale of the vehicle to ensure they followed the Uniform Commercial Code requirements for a commercially reasonable sale. If they failed to notify you of the auction or sold the car for a price significantly below wholesale market value, you may have a legal defense against the deficiency judgment. As we move into the final part of this deep dive masterclass, we are going to synthesize everything we have learned. We are going to provide the ultimate 2026 checklist for car buying, the specific clinical steps you must take to ensure you never end up like Daniel. We will look at the exact ratio of income to loan value that historical trends suggest is sustainable, the secret of the 3-year rule, and how to build a fortress around your credit score so that you are the one dictating terms to the bank, not the other way around. In the final section, we are going to give you the blueprint for the perfect car deal, from the first search to the final signature, ensuring that your next vehicle is a tool for your freedom, not a weight on your future. To build this tool, you must start with the foundation of what we call the Fortress Credit Strategy. In the 2026 financial landscape, your credit score is not just a number. It is a dynamic, moving target influenced by trended data and real-time utility reporting. Imagine a character named Olivia. Olivia is planning to buy a car in 6 months. Instead of walking onto the lot with whatever score she happens to have, she begins a clinical optimization of her profile. She knows that historical trends show a 50-point difference in a credit score can result in a 4% difference in APR, which on a $40,000 loan translates to thousands of dollars in interest savings. Olivia begins by lowering her credit utilization to below 10%, not just by paying down balances, but by requesting credit limit increases on her existing accounts. She ensures that her FICO 10T score, which lenders in 2026 favor for its 2-year look-back on payment consistency, shows a downward trend in total debt. This is the first step of the blueprint. You do not wait for the dealership to tell you what your credit is worth. You define your creditworthiness months before you ever look at a car. By the time Olivia is ready to shop, she is not a supplicant asking for a loan. She is a prime candidate that banks will compete to fund. The second phase of the blueprint is the April 20th 10 sustainability ratio. In 2026, where the average car price has hit record highs, the temptation to take a 7-year loan is immense. However, clinical data suggests that the only way to stay ahead of depreciation and high APRs is to follow a strict mathematical framework. You put 20% down. This immediate equity acts as a buffer against the rapid depreciation seen in 2026 models, particularly those with evolving software and battery tech. You limit the term to no more than 48 months. As we have seen in previous sections, extending a loan to 72 or 84 months at an 8 or 9% APR is a potential outcome that leads to thousands of dollars in wasted capital. Finally, you ensure the total cost of ownership, including the loan payment, insurance, and maintenance, does not exceed 10% of your gross monthly income. For Olivia, who earns $6,000 a month, her total car-related expenses must stay under $600. This prevents the car from becoming an anchor that stops her from investing in other appreciating assets. The third phase is the outside financing offensive. Before Olivia ever sets foot in a dealership, she visits 3 different credit unions. In the 2026 market, credit unions often have access to lower-cost capital and are more likely to offer a buy rate that is not marked up by a middleman. Olivia secures a pre-approval letter for a 5.5% APR. This letter is her most powerful weapon. It effectively decapitates the dealership's ability to sell her a marked-up 8% rate. When the finance manager asks her what monthly payment she is looking for, Olivia refuses to answer. Instead, she says she is a cash buyer from the dealership's perspective because her financing is already secured. This forces the dealership to negotiate on the only number that matters, the out-the-door price. The out-the-door price, or OTD, is the final clinical figure that includes the car, taxes, registration, and any non-negotiable fees. In 2026, dealerships often hide profit in electronic filing fees, nitrogen-filled tires, or ceramic coating packages that are pre-installed. Olivia demands a line-item buyer's order before she ever goes into the finance office. She audits every single fee. If the dealership refuses to remove a $500 documentation fee that exceeds the state's historical average, Olivia is prepared to walk away. This willingness to leave is the only real leverage a consumer has. Historical trends show that consumers who spend less than 2 hours at the dealership end up with better APRs and lower total costs than those who engage in a 6-hour marathon of attrition. Once the OTD price is settled, Olivia enters the final arena, the finance and insurance office. Even with her pre-approval, the manager might try to beat the rate. This is the only time Olivia considers dealership financing. If the manager can offer a 5.2% APR to beat her 5.5% pre-approval, she will take it, provided there are no hidden fees or forced product bundles. She performs a side-by-side clinical comparison of the Truth in Lending Act disclosure. This box at the top of the contract is the only place where the lender is legally required to show the true cost of the loan. Olivia checks the total of payments. This number shows her exactly how much she will pay over the life of the loan if she makes every payment on time. If that number is significantly higher than the car's price plus the expected interest, she knows there are hidden products like gap insurance or service contracts slipped into the principal. In 2026, we are seeing a trend of digital signatures where contracts are presented on large tablets. This makes it easy to scroll past the fine print. Olivia insists on reading every paragraph. She looks for the per diem interest rate, the prepayment penalty clause, which she ensures is non-existent, and the late fee structure. She verifies that the amount financed matches her buyer's order to the penny. If the manager claims a fee cannot be removed because it is in the computer, Olivia knows this is a psychological tactic. In the 2026 economy, every number in that computer is negotiable until the final digital signature is applied. After the deal is signed, the blueprint moves into the maintenance phase. Olivia does not just set up autopay and forget the loan. She utilizes the principal-only payment strategy we discussed in Part 6. Even an extra $25 a month, applied correctly to the principal, can shift the potential outcome of her loan by saving her hundreds of dollars and shortening the term by several months. She monitors the market every 6 months to see if interest rates have dropped. If the magic window opens and rates fall to 4%, she is ready to refinance immediately, provided her LTV ratio remains healthy due to her 20% down payment. The ultimate goal of this masterclass has been to move you from a passive participant in the automotive economy to a clinical operator. We have deconstructed the APR, exposed the hidden fees, analyzed the psychology of the dealership, and provided the mathematical tools to disrupt the lender's profit model. In 2026, a car should be a gateway to your life's work, your family's adventures, and your personal freedom. It should never be the reason you cannot retire, the reason you cannot buy a home, or the reason you stay awake at night fearing the sound of a tow truck. By following this blueprint, you are protecting your future self from the silent erosion of high-interest debt. You are taking control of the 1001 small decisions that dictate your financial destiny. This is the end of the masterclass, but it is only the beginning of your journey as an informed, empowered American consumer. You now have the data, the case studies, and the clinical mindset to navigate any dealership in the country with total confidence. But while you have mastered the car loan, there is another massive financial pillar that is shifting in 2026. As the housing market enters a new cycle of volatility, the relationship between your car debt and your ability to secure a mortgage has never been more complex. In our next deep dive series, we are going to look at the secret debt-to-income ratios that mortgage lenders are using right now to disqualify buyers with high car payments. We will look at how to structure your entire financial portfolio to prepare for the biggest purchase of your life. If you thought the car dealership was a battleground, wait until you see what happens behind the closed doors of a mortgage underwriter.